In the world of global finance, few names carry as much influence as BlackRock. It is not a brand most people interact with directly. It does not operate bank branches on street corners. It does not advertise during prime-time television. And yet, it quietly oversees trillions of dollars on behalf of governments, institutions, pension funds, and individual investors around the globe. How did one firm grow into such a dominant force in global markets? What decisions shaped its rise? And what does that mean for the world of money, markets, and everyday investors? To answer those questions, we need to step back to a time when financial markets were expanding rapidly, but the tools to understand risk were still evolving. The late 1980s were defined by both innovation and instability. Financial engineering was accelerating. New mortgage-backed securities and complex debt instruments were being created at a pace that outstripped the systems designed to measure their risk. Institutions were growing larger, markets were becoming more interconnected, and transparency was limited. It was in this environment that a small group of professionals, led by Larry Fink, recognized a critical problem. Risk was not being properly measured. Investors were chasing yield, but they lacked a comprehensive view of the exposure embedded inside their portfolios. In 1988, BlackRock was founded with a specific focus: disciplined risk management combined with fixed income expertise. From the beginning, the firm positioned itself differently. While many competitors emphasized aggressive returns, BlackRock emphasized control, data, and structure. As financial markets expanded through the 1990s, BlackRock invested heavily in technology. This investment would eventually become one of its defining advantages. The firm developed Aladdin, a sophisticated risk management and portfolio analysis platform capable of modeling complex financial scenarios across global markets. Aladdin was not simply a tool for internal use. Over time, it became a service offered to other financial institutions. Banks, insurance companies, asset managers, and even central banks began using the platform to evaluate risk exposure, stress test portfolios, and understand interconnected vulnerabilities. This technological backbone quietly embedded BlackRock into the infrastructure of global finance. By the early 2000s, the firm had grown steadily, but its most dramatic expansion came during a moment of crisis. In 2008, the global financial system experienced its most severe shock since the Great Depression. Major institutions collapsed, liquidity evaporated, markets froze. Complex mortgage-backed securities, once considered safe, revealed layers of hidden risk. During this period of instability, governments and central banks needed expertise. They needed firms capable of analyzing distressed assets and untangling complicated balance sheets. BlackRock was selected to assist in evaluating and managing troubled portfolios, including assets tied to major financial institutions. The crisis, while devastating for the global economy, positioned BlackRock as a trusted operator in moments of systemic stress. In 2009, the firm made a transformative acquisition. It purchased Barclays Global Investors, which included the iShares ETF business. This move dramatically expanded BlackRock's scale and placed it at the center of a powerful structural shift in investing. Exchange-traded funds, or ETFs, were gaining popularity. Unlike traditional actively managed funds that attempt to outperform the market, ETFs often track broad indexes at low cost. They offer diversification, transparency, and efficiency. Through iShares, BlackRock became one of the largest providers of ETFs in the world. As passive investing accelerated, capital flowed steadily into index-based products. Pension funds, retirement accounts, and individual investors increasingly favored lower-cost, diversified strategies over high-fee active management. This shift was not simply a trend. It represented a fundamental transformation in how capital was allocated globally. By managing trillions of dollars across index funds, BlackRock accumulated ownership stakes in thousands of companies. In many cases, it became one of the largest shareholders in major corporations across industries, from technology to energy to healthcare. This concentration raised important questions. When a single asset manager holds significant stakes across competing firms within the same industry, what does that mean for corporate governance? How does proxy voting influence strategic decisions? To what extent does passive ownership shape executive accountability? BlackRock maintains that it acts as a fiduciary. Its responsibility, according to the firm, is to act in the best interests of its clients. It does not claim to manage companies directly. Instead, it engages with management teams, votes on shareholder proposals, and promotes long-term value creation. Yet its scale means that its voice carries weight. In recent years, additional themes have emerged. Environmental, social, and governance considerations, often referred to as ESG, became part of the global investment conversation. BlackRock publicly emphasized the importance of sustainability and long-term risk factors tied to climate and governance. Supporters argue that large asset managers can encourage responsible corporate behavior. Critics question whether such influence concentrates too much power in private financial institutions. Regardless of perspective, the numbers are significant. BlackRock oversees assets measured in the trillions of dollars, making it one of the largest asset managers in the world. Its technology platform connects it to financial institutions globally. Its index funds hold ownership stakes across much of the corporate landscape. The firm does not operate like a traditional bank. It does not issue loans in the conventional sense. Instead, it acts as an intermediary between capital and opportunity, channeling savings into diversified portfolios that mirror the structure of modern markets. Its rise reflects broader structural changes: globalization of capital flows, digitization of risk management, and the growing preference for passive investment strategies. Understanding BlackRock, therefore, is not only about understanding a single company, it is about understanding how modern capitalism organizes money across borders and sectors. Financial power today is often quiet. It operates through algorithms, asset allocation models, and index construction methodologies. It influences outcomes through shareholder voting policies and engagement frameworks rather than public speeches. BlackRock stands at the intersection of these forces. Its story illustrates how technology, scale, and strategic positioning during moments of crisis can reshape the balance of influence in global markets. For investors, the implications are complex. On one hand, access to low-cost, diversified funds has expanded financial participation. On the other, concentration of ownership has intensified debates about systemic risk and governance. The modern financial system is deeply interconnected. Asset managers, banks, governments, and corporations operate within networks where decisions in one region can ripple across continents. BlackRock did not create this system alone, but it has become one of its most central nodes. And as markets continue to evolve, the role of large asset managers will remain a subject of scrutiny, debate, and analysis. Understanding this helps us better grasp how modern capitalism organizes money across borders and sectors.